Hi class, this is Liz Brown with Richland College Accounting 2301 Financial Accounting. Today we're talking about our inventory chapter. So let's review some of the concepts that we talked about. Please be sure you've read the chapter and taken a look at the other resources that are posted out in eCampus. So let's do a quick review here and work a problem together. Wanted to start off by showing dealer. I find this is really helpful, so please reference this as we do our problems. And let's jump into this example that we saw in our books. So we have beginning inventory, which is an asset, so over here on dealer, of $20,000. During the year, we purchased 90,000 additional assets. This gives us total inventory available for sale of $110,000. At the end of the year, we have ending inventory of $30,000. Therefore, we must have had sales of $80,000. We call sales expense or inventory expense cost of goods sold. Cost of goods sold is commonly referred to as COGS, C-O-G-S, in the business world. So I'm going to refer to it as COGS here in our example because it's much quicker to say and to write out. So let's take a look at this in our T accounts, which might be more comfortable for some of us. Beginning inventory is $20,000. We're seeing that with a debit balance on the left here on inventory, all right, with our balance. Now we have purchases during the year of $90,000. So what we're going to do is a purchase is going to increase our T account. There we go. So we used to have $20,000 in inventory. Now we're adding $90,000 for $110,000. What this is going to look like is an increase in inventory. We see this here of $90,000. Let's assume that we paid cash. So we would pay cash to our supplier of $90,000. Now we're seeing, just as we see up here, we've already discussed this in our T account, the $110,000 as our total inventory available for sale. Now what we're going to see is the ending inventory is going to be $30,000. In this case, let's assume that we count at the end of the year and we have $30,000 in our inventory. Well, we must have had a decrease in inventory. Once again, an asset, so a decrease is going to be over here on the right-hand side with the credit. It's going to be a decrease. So what do we need to do to decrease this account 80,000? So what we're seeing is 20 plus 90 less 80,000 equals 30,000. Let's walk through these journal entries. Let's say we're going to do a sale where we're going to sell all 80,000 to one customer. The customer is going to pay us $100,000 in cash. Unlike our previous entries in the beginning of the book, where we're doing service revenue, here we're going to have two pieces or two journal entries that are going to make up this transaction. So we've got two things happening. The first is we used to have $80,000 in inventory, and now that is gone. That's walked out of the door with our customer. And the other piece is now we're getting cash from our customer. So in this case, we're saying $100,000 in cash for the customer. So let's record those two different pieces. So we're seeing here, I've added those over here. So cost of goods sold, that is going to be what's going to happen when we sell our inventory. The customer buys $80,000 of inventory. We're going to have a cost of goods sold of $80,000 and a matching reduction in our inventory of that $80,000. So these two pieces are going to make up our journal entry. The other side is going to be, so we're seeing that sell inventory. Part 1, sell all of inventory. Part 2, sell inventory for $100,000. Our cash is going to go up. It's an asset of $100,000. And our revenue is going to go up of $100,000 as well. So what do we have here? If we did a mini income statement here, we'd have revenues of $100,000 less expenses of $80,000 give us net income of $20,000. We have made $20,000 on this transaction. This may seem basic, but I want you guys to understand not only how this works here, but also how it works in the T account. Beginning balance, purchases, less any cost of goods sold that goes to this T account equals our ending inventory balance. This is the journal entry to purchase inventory. And these are the two entries that we need to have when we make a sale of inventory. A decrease of the inventory and an increase of the expense, an increase of cash, if we're getting paid with cash, this could also be accounts receivable, and an increase of revenue. The next part of this class that we're going to look at is LIFO, FIFO, and weighted average. These are ways to account for our inventory. LIFO stands for last in, first out. FIFO stands for first in, first out. And weighted average, which will be a calculation. I like to use this example in class with my students to talk about the way LIFO and FIFO work. This is Central Market or Whole Foods or another store if you've seen these. I like to think about how we fill these bins at the top. So the way these bins are filled is we take a bucket at the top and pour, and the inventory goes to the bottom. So when you open this bin to take out whatever you're buying, let's say jelly beans, you're going to get the first items that were poured in are the first items you're going to take out. This is an example of what FIFO might look like in a store. LIFO is the opposite. These bins at the bottom represent LIFO. As we fill them from the top, and the first items go to the bottom, and the last items stand at the top. So when you go to purchase these, when you scoop in, the first items are at the bottom, but the last items are the first out. So this is an example of LIFO. Also, it's important to note that a company can select whichever method they prefer to use to account for their inventory, even though at this Whole Foods, you might have bins that are FIFO and bins that are LIFO. The store is going to pick one way to measure their inventory, and it does not have to be identical to the way that they sell their goods. Here we're taking a look at the example from the book. This is the results of the book, so please be sure to do this in the reading. I just wanted to make some comments on this. This is using different methods to account for inventory, assuming we have purchased $10,000 of inventory. I want to make sure everybody sees that you will have $10,000 between cost of goods sold and ending inventory, no matter which method you use. So here's some arrows here. This green number here plus this blue shaded number here is always going to equal $10,000. That's how much inventory you had. So your cost of goods sold, the items that you sold, plus your ending inventory must equal $10,000. So that is true for each of these three methods. So I want to make sure everybody sees that the amount of inventory we have is the same between those methods, and we can take the same transactions and record them in different ways using FIFO, LIFO, and weighted average. That is a choice that management gets to make. So here we're seeing that, and this is assuming costs are rising, that ending inventory, take a look at this. This is on the balance sheet. It is the highest with FIFO and the lowest with LIFO. Weighted average, just like you would expect an average, is in the middle. Cost of goods sold is the opposite. We have the highest cost of goods sold, which is an expense on the income statement, with LIFO, and the lowest cost of goods sold with FIFO. Again, weighted average is in the middle there. So what we're seeing here is that if management chooses LIFO, FIFO, or weighted average, they have control over if their ending inventory is going to be higher or lower, and their cost of goods sold is going to be higher or lower. Now, you have to use the same method. You can't switch between showing your inventory in one method and showing your cost of goods sold in another method. Some students would ask, why would anybody ever use LIFO, right? It makes our inventory, our assets lower, and our expenses higher. And the reason is taxes, right? You pay less taxes if you have higher expenses. So let's look at our gross profits here. With sales revenue, now these are the same examples. This is the same company using one method, the same company using another method, and the same company using a third method. So sales revenue selling, in this example, 800 is going to be 12,000 across. But look at our gross profit. It varies depending on which method we use. So I just think this is a really good example and a really good way to summarize what we're doing with these three different methods. Also be sure to take a look at the other resource we have out there for lower of cost or realizable value. And we're going to do a review together on the multi-step income statement.